Okay, happy to make a start. Welcome everyone for joining, and there'll be a few more people joining as we begin. My name's PJ McCluskey, and I'm joined with my good colleague Warwick Anderson. Today we're going to go through 10 hot topics in the cost of capital. Just by way of some background, we're coming at this from a regulatory economics standpoint, which is one of the services that we provide, and we're coming at this mostly from a monopoly network standpoint. But the cost of capital is also prevalent across all the industries and across multiple sectors in the value chain, whether that be energy or water, for example, and other sectors as well. Myself and Warwick have been working on the cost of capital for some years now. We've also been working on some recent projects in Australia, in the UK, and in the Middle East, and we wanted to share some of our experience. The cost of capital is one of the regulatory economics topics as that falls into our expertise, and you'll also see some other services that we provide as well on this first slide. So we'll just hand over to Warwick to take us through the first of the hot topics. Thanks, Warwick.
Yes, very good, PJ. Excellent to be with you. Yes, so we've been doing some work in the background surveying cost of capital issues and thought that it would be a good opportunity to share those. And so very pleased to be doing this seminar today. Now, in cost of capital, there are lots and lots of issues and lots of opinions. We've come up with a list of 10 hot topics. You may well have a different list, and that's just fine. But look, cost of capital is a really important issue for regulated businesses. In Australia, the AER has estimated that cost of capital is worth around half of the regulated revenue, and very small changes in cost of capital can lead to big changes in revenue. And so that's why it takes such prominence as an issue. So here we go. The first of the issues that we've identified is around climate change. And what we have seen is that governments around the world have been taking action on climate change and also changing the regulatory framework. So, for example, in Australia, late last year, the government's made changes to the energy legislation and added a new clause in the objective around around requiring the regulator, when making their decision, to take into account any targets that have been set on reducing emissions. And look, it's early days in Australia and New Zealand in terms of the effect of those changes to the objectives. But what we've seen so far is a couple of things. First of all, changes around what it means to have greater electrification, and also what it means to have greater resilience in networks to more severe weather events. And so primarily what we have seen so far is changes in forecasts, in expenditure, and the way the networks are preparing themselves for the future. But a really interesting question is around, well, what's the impact for cost of capital? Is this a diversifiable risk? Is it not? And what impact should it have in terms of setting rates of return?
And one of the really interesting things here, Warwick, is that climate change is starting to be enacted into laws and regulations, and therefore having a legal effect on decisions that we're seeing in the different regions.
Yep. All right, our second topic is around stability and predictability of approach. Now, it's fairly typical to see regulators in different industries and different locations take different approaches to issues. But what we have seen is that once an approach gets established, there is a fair degree of momentum to maintain that approach. There was a really interesting passage in the AER's rate of return documents when they made their last rate of return decision. And the AER said, "We did not come to this process with the expectation of only making minimal changes. But as the process played out, and as the AER heard from stakeholders, it evolved into a situation where both consumers and the regulated businesses were saying, look, we think there ought to be a high bar for change."
Yeah, and a high bar for change we see also being interpreted in terms of the approach that the regulators are taking. But obviously there's big changes in the data at the moment in terms of interest rates. And so the approach might remain the same, but the numbers might change quite a lot from previous decisions.
Yep. Our third issue is around reasonableness checks. So typically what happens when a regulator is estimating a cost of capital, they have a model that they apply, and then they make decisions about the individual inputs and parameters that go into that model. But what we see is that regulators, once they get to the end, they like to be able to sit back and ask themselves, does this outcome look reasonable? Is there anything odd about the outcome that we're seeing? And we have seen regulators take a lot more effort in checking their results. Now, look, this is not easy. The data to look at a rate of return in total is no better than the data that you have for the individual inputs, and potentially in a number of places it's even worse. But some of the areas where we have seen quite a bit of activity are around financeability metrics and checking the overall revenue and allowances, looking at regulatory asset base multiples, and also where it's available, comparing regulated rates of return to the results that have been coming out of competitive processes.
Yep. And one of the main reasonableness checks that we've seen across different regions, Warwick referred to it there as the regulatory asset base multiples, or RAB multiples. And these can go by different names as well. In the UK, for example, it's normally referred to as market to asset ratios, but it's exactly the same evidence, aside from the branding on the evidence. But we do see that as a dominant piece of evidence, and we do notice that there has been transactions since previous regulatory decisions. We noted one from Northern Ireland, for example, on Phoenix Natural Gas, which was sold recently.
Now, regulated utilities seem to be highly attractive. And what we have seen is that there is a trend for these entities to be acquired in private transactions and delisted. And in Australia, for example, we have seen the two best electricity comparators both acquired and delisted. And so with that trend, what it means is that regulators have less market data than they used to in order to inform their decisions. And so faced with that diminishing comparator set, regulators are now asking themselves the question, well, where do we get our market data to inform our decisions going forward? And the two options that are most obvious is, firstly, you rely on the data that you already have, but that's getting increasingly old, or you expand your comparator set and you start looking at businesses that are not as comparable to the businesses that you're regulating. And so what we are seeing is that regulators are signalling that they are going to be undertaking much more work in this space.
Yeah, there's a pretty big issue for the cost of capital because we don't have a listed company on a stock exchange. It's very difficult to estimate the equity beta or the asset beta. And so it's very hard to estimate the cost of capital for the most recent periods. So this is becoming an increasingly issue. Hopefully we'll see some companies being listed, but obviously these are normally very, very big companies that regulators like to base their opinions on for monopoly networks.
So this issue, the term for estimating the cost of equity, is a bit of an obscure issue, but it was actually quite a hot issue in both Australia and New Zealand recently. So to set some background around this issue, when you're estimating the cost of equity, you're looking forward into the future. How far into the future should you look? Should it be the length of the regulatory period? Because the regulator will then reset at the end of the regulatory period? Or do you look even longer and potentially even try and align with the length of the regulatory assets? And so in Australia, we have seen regulators take different approaches and also change their approach. The AER looked at this issue really deeply. The AER currently uses a 10-year term, and it contemplated changing that to match the life of the regulatory period, and there was a lot of exchange backwards and forwards on that. Ultimately, the AER decided to stay with a 10-year term. It then also appeared as an issue when the New Zealand Commerce Commission were making their decision. New Zealand has typically used a period matching the length of the regulatory period, and they were under a lot of pressure to change, but did not. They went through the analysis and came to the conclusion that in their situation, matching the term of the regulatory period was the right outcome.
Yeah, thanks, Warwick. This was a huge topic in Australia and New Zealand, as you mentioned, but it's interesting that it hasn't been a huge topic elsewhere in other countries for other regulators. But we think it might be a hot topic that might arise over the coming years. Intuitively, the cost of capital, the cost of equity, the cost of debt, they all depend on the investment horizon. And so, in other words, the term of the investment. So a 10-year investment, even if it's the exact same asset, normally commands a different return than a 5-year asset or a 20-year asset and a 20-year investment and so forth. So it's quite interesting that we have different regulators having different opinions on this particular topic. And it's also interesting that it has been discussed in lots of detail by some regulators and considered in lots of detail by some regulators, but maybe not discussed at all by other regulators for something that's so fundamental to the costs and to the returns in these industries, in any industry as well. So this is a financial issue that applies across assets and investments.
All right. Look, this next topic comes really from the first topic that we raised around climate change. And what we are seeing is that with the growth in renewable generation, there is lots of new investment needed, particularly in electricity transmission, to support that new investment. And so that then raises the question, if we're going into a period where we have these large investments coming on board, is the WACC sufficient to support the investments that are needed? And that was an important question that both the AER and New Zealand Commerce Commission looked at when they were doing their determinations. One area where it particularly bites is when you're looking to undertake an investment, you want your cost of capital contemporaneous with that investment. And if regulators are using historical averages, and some regulators use a trailing average cost of debt, then you can be in the circumstance where the historical return is not lining up with the current market rates. And that's the case in Australia at the moment. So presently, the cost of debt is sitting around about 2% higher than the trailing average cost of debt. And so the AER, when they were looking at this issue, went to a lot of work around how they might modify the trailing average cost of debt. And they considered introducing a weighted average trailing cost of debt. In the end, they didn't do so. And it was surprising that the businesses that were looking to undertake the investments weren't keen on changing approach. They valued the stability of the approach more highly than the potential consequences of having a mismatch. But the AER has signalled that that's an issue that they're going to look at further, and when they get round to doing their next rate of return determination in 2026, I'm sure that's going to be an issue which will be front and centre.
And we mentioned the cost of debt here, and the same issue can apply to the cost of equity as well. And so the two major issues that we're seeing is large new investment, but also a market change in the market rates as well. So the interest rate increases that we've seen globally flow through to both the cost of equity and the cost of debt. And so when you're making huge investments, you're taking on a very different cost, and you're also making a larger potentially scale of investment as well. So some regulators have some automated mechanisms and some don't, and so it'll be really interesting to see how that really flushes out. Everything was great for 20 years when interest rates were falling, but now that they've risen quite a lot over the last few years, this is going to be a huge issue, we think, for some countries more than others, and some regulators more than others.
All right, the market risk premium. It only comes in at number 7, but potentially this is the hardest issue in cost of capital. You're looking into the future, you're trying to get a handle on expectations. What sort of returns are investors looking for in order to part with their money? The information and data in this space is probably the weakest of all of the cost of capital parameters. And there are also very different approaches taken by regulators. So we see some regulators that make a determination and they set a fixed MRP, and that fixed MRP then rides through a period, whereas other regulators will set a fixed return on equity, and then that rides even though interest rates are moving underneath it. One of the areas that is attracting a lot of interest is around how do you estimate a forward-looking market risk premium? And one of the models that has been used by some regulators is a dividend growth model, and some regulators are using it determinatively in their determinations, others looking at it just as another set of information source. For sure, we are going to see regulators doing a lot more work around how you estimate the market risk premium going forward.
Yeah, there's a huge issue, the market risk premium because interest rates have changed so much, what it means is that the premium is challenged in terms of its policy. So some regulators have a very different policy to the market risk premium, where whether it's either fixed or whether it varies with interest rates. And so there's a lot of discussion on this topic, I think, coming up over the coming years. A lot of potential policies that have been in force for 10, 15, 20 years, for example, in the UK will be challenged. I think the arguments will be the market risk premium needs to be larger than it might be in some decisions, because as interest rates increase, that can reduce the market risk premium, especially in the UK regulators' decisions. So that's going to be a huge focus. It can be dressed up in different ways as well, and so the arguments will be presented very differently depending on the interests of the stakeholders as well. So we think this can be a very complicated topic. Even at its most basic fundamentals, it can be complicated to follow this. And we think that complexity will lead to some huge challenges for regulators to stand by their previous policies in the face of rising interest rates.
So while the previous topic, I think, was the hardest, this one is the most interesting. And again, it's flows out of the first issue that we identified around climate change. And what we are seeing is a trend towards greater electrification and less gas. So I'm here in Canberra, and the government here in Canberra has taken a very active role in gas. So they have banned new gas connections in the Australian Capital Territory. They have a clear deadline for getting people off gas by 2035. And I just saw them advertising on the TV, encouraging people to switch from their gas appliances to their electricity appliances. So what does that mean for the sunk investments in gas pipelines going forward? Is this a risk that is already incorporated into the cost of capital? Is it an asymmetric risk that needs to be dealt with in a different way? To date, what we have seen is regulators have tended not to make adjustments inside the cost of capital, but rather they are taking action elsewhere in the regulatory stack. So, for example, what we have seen in both Australia and New Zealand is that regulators have taken the step to speed up depreciation of the regulatory asset base. Now, that raises prices in the short term and potentially encourages more customers to leave the network more quickly. And so that's one of the challenges. How quickly can you return capital, and is there going to be a residual risk there, and how should that residual risk be accommodated?
Yes, and again, we're seeing this popping up in different regions. For example, Oman, Australia, UK. I think it'll be a live issue. I think other regions will face similar issues because this will be a pretty much global phenomenon, the switch away from natural gas to electricity. And so some topics that pop up in the cost of capital are whether it's a diversifiable risk, whether investors should be compensated earlier, and therefore it's not a cost of capital issue as large as it would be if it was to remain open. Obviously, every region will have different depreciation policies and different degrees of outstanding assets that have not yet been paid for. And so also earlier I mentioned a company in Northern Ireland called Phoenix Natural Gas, I called it, but it's actually been rebranded to Phoenix Energy, which itself tells you a little bit about the issue. But I think as well, the fact that that's been sold and the value of the sale, it can be portrayed as an example of a risk materializing. Now, that's very arguable, but I think that can be a topic that can be put forward by stakeholders. But yes, the stranding risk will be a big topic going forward, and whether and how it affects the cost of capital and other policies as well, depreciation and other policies as well, will be interesting to see how that shakes out.
So once again, linked back to climate change, what we are seeing is large transmission investments going in to support renewable generation. And as a competition economist, I would say this is a fantastic opportunity to move out of the regulatory space, to auction the right to build, own and operate these assets. And so long as the competition is strong and effective, you can end up with really good results of this. Interestingly, for regulators, what it also does is it gives them another piece of information to look at when they're undertaking their reasonableness checks. And what we have seen in the UK, for example, is Ofgem, in making its decisions, looks towards the implied returns coming out of offshore transmission.
Yeah, and in the chart we show a piece of analysis on off-toll asset sales or tenders, and we show the numbers for the implied rate of return, the IRR, or internal rate of return, from those transactions, from the cost of equity perspective on a nominal basis. But you can see the decrease over the years, but you can see also that there's going to be some lag in that information coming through. So the tenders that we might see over the coming years in different regions will help, but we will see a lag in that information, and therefore how valuable it is to regulators as well. So it's something that regulators will try and push and try and rely on, but there will be a lag on that information, and the availability and transparency and speed of that information is going to be important for any decisions over the coming years.
So this final issue, you'd be quite right in saying, look, this is not strictly a cost of capital issue, but it is a topic where it can have a massive influence on the regulatory process and the way that consumers are engaged in the process. In Australia, we used to have a merits review process, and it was the case that just over 60% of all decisions by the AER went to merits review. It was a horrible process. What would happen is the regulated businesses would put in proposals that were designed for the merits review body, not the regulator, and consumers were pretty much left out of the process entirely. They weren't able to engage with the documents the business provided to the regulator, and then they didn't have the resources to participate in the merits review process. In 2017, the Australian government decided that process wasn't working for consumers, and they removed merits review. Since then, we have seen a fundamental change in the regulatory framework. What we are seeing is that the regulated businesses are genuinely engaging with their consumers. Consumers are able to influence the proposals that come into the regulator, and the regulator has also shifted its approach. Rather than having to deal with every issue in minutiae, the regulator can now sit back and take more of a holistic approach. And in the most recent decisions made by the AER, what we saw is that there were 7 businesses involved. Out of those 7 businesses, the AER was able to accept the OPEX proposal from all 7 businesses, and they were able to accept the CapEx proposal from 6 of the 7 businesses. So it's been a really important change, and I think it's a topic that we'd like to do some more work on, PJ, and maybe we'll do another presentation on consumer engagement and how we see that as best practice.
Indeed, Warwick, and the really interesting thing about merits review coming up on number 10 is that all the topics on the cost of capital, they do depend on the game of regulation in its entirety, of which the ability to appeal and ask for a reference to some other body obviously plays a big part. And so you mentioned the change in Australia there, Warwick, and we know that there's a lot of differences between other countries, and even within certain places like the UK, there's a different basis of the appeal mechanism and appeal mechanisms and redetermination mechanisms as well. So that's a really interesting dynamic that underlies all of the decisions and all of the debates. And we can see how big an impact that's had when that has changed. And also in the UK, it's frequently discussed about how to change the regulatory frameworks for different sectors. But absolutely, there's a few topics there for future sessions. Let us know if you would like us to get into those. Consumer engagement, for example, being one of those, but also just the appeal frameworks in the different countries and how that impacts the stakeholders.
And look, finally, there's a whole range of issues that potentially come into play as well. We've just listed another 9. The list could go on, I'm sure. I'll just highlight the first one, which is accuracy in estimating the cost of debt. What we have seen in Australia is that it's possible for regulators to very accurately estimate the cost of debt and to set up indicators that will allow them to track it very accurately through the regulatory process. And so, look, potentially that's another topic that we could take up as well. So, thank you.
Thanks, everyone. Yep, they're very much welcome any comments or questions after the session. Feel free to send us an email. You'll see some of our details here on the final slide, and feel free to get in touch by email as desired. Very happy to help with any of these cost of capital topics in your respective regions or jurisdictions or industries. Thanks very much for attending, and hopefully see you next time.